Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is Fergus Hodgson with the Gold Newsletter Podcast, joined by my co-host Brian London in New Orleans, Louisiana. And we have Pamela and Marianne Aden, whom I recently heard described as the Matriarchs of investing, which I think is a moniker that fits. They are the long-time publishers of the Aden Forecast for about 4 decades, and they're based in San Jose, Costa Rica. So, Mary, Anne, and Pamela, welcome back to the Gold Newsletter Podcast.
Well, thank you very much. It's a pleasure to be with you today.
As I said, you are a repeat guest. I've seen you a bunch of times at the New Orleans Investment Conference, and Brian holds you in high regard. He says you have a very loyal following, and the thing that drew his attention, now this is a couple of months back now, but was just that your interpretation that you were basically advocating a turn to or emphasis towards the U.S. stock market as a change from perhaps late last year. We've got a bunch of articles for you on this topic. One of them is the Fed hits the brakes from a couple of months ago. Why don't you explain that thinking that basically, unlike the many bears we've had on recently, you are more bullish, at least in the short run, about the U.S. stock market?
Okay, no, we'll be happy to answer that. I don't know if you know that we ended up assuming Richard Russell's newsletter when he passed away, and we got more involved in Dow theory because of that.
No, I don't know. I don't know that story. Do you want to clarify what the situation is?
Oh, well, Richard Russell, before he passed away, we were working with him on different items, and it was known to his family and to him that we would take over his newsletter subscribers when he passed away. And so we did. And so because of that, we were very involved with their Dow theory team. And for a couple years, maybe a year and a half, we were working with them very closely. And then we just assumed the letter altogether and kind of merged it into with our letter. And so anyway, the Dow theory it's open to interpretation depending on it's kind of like all technical analysis in a way, because some people might say, oh, gee, here's a breakout, and someone will say, no, and it isn't. And so there's always a little room for differences. But as far as we were concerned, the Dow theory did trigger a buy signal on April 1st, and that was when the Dow and the transportations both broke above their February highs. Now, some people argue that that's not a real Dow theory confirmation. But Matt Kirchhoff, who was the Dow theory expert at Dow Theory Letters and worked many years with Richard Russell, he agrees. And so based on that, and after that, the stock market surged up until just recently the NASDAQ and the S&P 500 broke into new record high territory. Now, in recent days, the market's come down, but it's still, based on all of our analysis and the fact that interest rates are, again, looking like they're going to go lower, based on our leading indicators, based on our moving averages and everything we look at, both fundamentally and technically, it does say that the stock market looks like it's going to head higher here in the months ahead.
Do you want to clarify that Dow theory, the technical analysis you were referring to? I'm not so familiar with that particular approach.
Well, it's one approach, but we also like to add that we have other things we look at.
Sure, of course.
The PTI, the primary trend index, is also very insightful, and we have our own indicators as well that we followed throughout the years that tell us when there's a green light or red light on the stock market. But overall, taking it all into consideration, there's a lot of bullishness to be said within this consolidation period we've had for since the Dow, that triple top, if you want to call it, over the last year or so. We could say that the Dow itself nor the trends have broken into record high territory. So there's a lot of room for indecision,
And the trade talks are weighing heavily on it, as you know, and it really isn't a full-on bull market melt up, if you will, right this moment. But it certainly looks good within this sideways consolidation it's been in and the rise it's had this year within this major, massive consolidation period. So we feel there's room to be in it a bit, but we realizing that we're probably, if we have one last leg in the bull, this is it. And this is, we agree, we're in like the 8th inning, if you want to call it, in the major bull market since 2009. But our point is that we are cautiously bullish, and you could argue who's more cautious than the other, but we are bullish enough to have certain select positions in the market.
And I just wanted to another point. This bull market that started in 2009, it never really had a blow-off, exciting, where everybody's going crazy over stocks, that kind of a top, like, say, for example, if you remember what happened in 2000. And that's very typical of a long-term bull market. And all the greats will agree on this. Richard Russell, Harry Schultz, all the veterans, they will tell you that almost all bull markets, in fact, Richard Russell used to say he didn't know of a bull market that ended in any other way. They will end with this frothy excitement, and usually investors will make more money in that last year and a half of a bull market than they did in the entire years, all the years before it, because that's the public pours in, it gets very exciting. And if you can remember the excitement about the dot-com phase in 2000, that's kind of what we're looking for. Some people refer to it as the melt-up, but that hasn't happened yet. So that's, and again, it's not saying nothing has to happen, but we think that's still to come. And one positive thing, and we think this is the most important, are that it looks increasingly that interest rates are going to stay low, and as long as they're low, they're very bullish for the stock market.
Mike Larson calls it the Uber bubble, basically a new tech bubble.
Yeah, and ladies, I'm glad you're setting this foundation, because I know, and a lot of people know, that you were such great friends with Richard Russell, who is the master of Dow theory analysis, and he was also a good friend of our organization and the New Orleans conference over the years. But I guess I never really thought about how, now that you've taken over his publication, you're synthesizing and combining Dow theory with your proprietary technical analysis that you've used for so many decades now. So I guess I'm kind of curious, how is that impacting your analysis? Are you getting from occasion conflicting signals, and what kind of implications is that having on your work and your calls on the markets?
Well, no, actually, all it does is enhance what we've always been doing. And we have Richard's proprietary PTI index and his Dow theory, and we've always used it. We always incorporated that with us anyway. Even when Richard was alive, we always appreciated what he had to say. But it did cause us, like Marianne said, to get closer to it because we were on top of it. And but that doesn't really change the fact that we've always wanted to be objective about all the market, all the asset classes. We are still bullish on the gold. We think that the low a few years ago is still, that's the reality, and this correction we've had is actually held up extremely well compared to the strong dollar. And actually, when you look at them, gold is really the best currency right today, even as it stands right now, even though it's not seen like that right now. It is doing that. And so that is only going to get better. So we like both. And one thing that's interesting too, Brian, is that when you look at this, a big, huge picture of the stock market and gold market, whenever there's been a change, like one being better than the other, although they can be good together at the same time, there's usually a long transition period between, like say, the underdog then taking over the spot and the other one to come down on a major trend basis. We think that's still happening, and it could be a year away, it could be not. The timing isn't clear. It's more the idea that they're trading places. We still think that's still still a thing that's going on right now and has been for a couple of years. We call it the transition time from stocks to tangibles. So we still have that there. And if we do have a melt-up, maybe gold will just not have that great takeoff until for another, a little more delay, but it doesn't mean that it's a bear market by all means. It's because there's everything we follow with gold still shows a very good strength there, an underlying strength that is very admirable for the gold price to have right now. Like everybody else, we're still looking for that great breakout. The same as the stock market, we're still looking for all of the market to break out to record high. So, gold at 1380, or to say for a clear breakout, is what we're looking for, 1370. And just like the Dow hitting a record high. So none of them have done that, but they all look good. So we're kind of in that vein right now.
For more than 40 years, top financial experts and private investors from all over the world have gathered for the New Orleans Investment Conference to discover new opportunities and strategies, exchange ideas, and plan for the coming year. To learn more about today's investing environment and updates, join Peter Schiff, Brian London, Peter Bookvar, Rick Rule, Doug Casey, and dozens of experts at this year's event from the 1st to 4th of November. Go to neworleansconference.com to register. For a limited time, enter promo code PODCAST for a free Gold Club upgrade.
That's what I find fascinating about and valuable about technical analysis, is that it takes out the emotions, because I look at gold market every day and obviously very much invested in it and emotionally involved, but the technical analysis kind of takes all that out. That, for example, the last couple of days of volatility we've seen in the stock market, if the technicals are showing that it's still in a bull market, then those are buying opportunities. And you mentioned gold. I'm very pleased to see that you're agreeing with my views on gold, and even though I tend to doubt them sometimes, but I look at gold at having bottomed in December of 2015, and for a while, though, we had higher highs and higher lows, but we kind of broke that. Does that worry you from a technical standpoint? In what kind of formations are you seeing? Are you seeing a broad bottoming? Are you seeing some people are pointing to a cup and handle formation? Or are you looking at other indicators to show that gold's kind of sideways action is still in a strengthening or an eventual bullish formation?
Oh, no, definitely a bullish formation. In fact, the decline we've had since February 20th has been a mild decline. And not only is gold mild, the mild decline itself, granted gold shares fell more, but still, that doesn't really take away from the fact that gold itself has only been a mild decline in the face of a strong dollar, in the face of the interest rates in the U.S. being the highest of the world, and everyone seems to be using the dollar, going to the dollar as a currency, people in the currency market. And in spite of that, gold holding up very firm. That shows a lot of strength. And granted, it's been the lower lows since February, but it's only been a few months, and it's been a gradual decline. So actually, we think gold's behaving beautifully within this correction. And when with intermediate moves that we follow closely, this one is supposed to be, I put that in parentheses because nothing's supposed to do anything, but at this time of the intermediate moves, gold should have a moderate decline, not a sharp decline, and indeed so far it hasn't. So we're looking even at, even if it went to as low as 1250, 1260, it still would be okay within the bull market that's been gathering steam since December 2015. So yes, and we also agree on that saucer bottom, that beautiful 6-year saucer bottom it's been forming. And with that, what we call it a couple of handle or call it a saucer bottom, we think that is end up being a big smile, as we call it, that bottom look. So no, we're still very positive on gold and gold shares very much. In fact, we think gold shares, there's some really good value right now in gold shares and the selective ones. There's a lot of good opportunity in the market.
Right before we got onto the podcast, I was writing a piece that's going out commenting on the decreasing or the falling volatility in gold. It's now at near multi-year lows from a volatility standpoint. and the Bollinger Bands have contracted, and it's all pointing to an eventual breakout soon, one way, upwards or downwards. And my view putting out there is that it's more likely, I think, to break upwards, because if it were to go lower, it would have to do so in the face of this really very significant shift in Fed policy toward a much more dovish policy. They've halted the rate hikes. Many people are looking at an eventual rate cut at some point, but it's still a major shift in policy just to halt their rate hike campaign. And in light of that fundamental factor, I find it difficult to imagine that gold could go much lower. And to your point about gold and stocks, dovish Fed is bullish for both of those asset classes as well.
Yes, it is. Mm-hmm. It is. And the Fed is increasingly becoming more and more dovish, and we think that's going to continue. We don't see any change at all, and that goes for what's happening with the economy and everything, and our leading indicators and the things we follow are reinforcing that. And we think interest rates are so important. We always jokingly say, because most people think they're a little boring, that they really are the most important market around, because based on what happens with interest rates, it will dictate what the other markets are going to do. So we always end on that very closely.
And including the real estate market.
Yeah, that's true. The correlation between gold prices and real interest rates may be the closest correlation you can find regarding gold and with anything else. Have you looked at that over the long? I know you have looked at it over the long term, but what are your views on that in the short term?
Well, in the short term, it was interesting. This right when the yield curve started inverting for the first time, just in the last month or so. The real interest rate, like on a T-bill sense, versus looking at real T-bills, 3 months, they were just wanting to pop up above what we call the zero line, meaning that interest rates are becoming higher than inflation. And now then they all of a sudden got hit by, of course, President Trump, but nevertheless they were hit. And at the time where they would have now started going higher than inflation. So for the moment, they're clearly real interest rates are still bullish for gold. It's a good background of bullishness for gold. There's nothing saying yet that that's going to be a problem. And so therefore it's still good.
Any other specific sectors that you're interested in or look particularly compelling?
Gold and bonds. If you look at them closely, they have been moving in lockstep for about 3 years now. That's unusual in the big picture, but in the picture of the last few years, they have been moving. One might lead and the other lag, but basically their movements have been very similar. So with interest rates now looking like they're going to stay low or go lower, and the fact that how bonds and gold, pretty much you could probably call them both safe havens, look like if that pattern that has developed over a few years continues, when gold rises, probably see bonds rise, and then with interest rates wanting to go lower for the next year or two, we see that bonds could end up being a very interesting investment too. And another thing that's interesting is when you compare the bond market and the utility market versus, say, the Dow Industrials on both counts, you see that they both are forming a major bottom, like they're bombed out and a major bottom forming, and they possibly could outperform the Dow Industrials themselves. So we're in a real interesting situation right now that if we like gold, we like bonds, we like stocks, it's like, what don't you like?
We like the dollar.
Yeah, we like the dollar for now because it is what it is, and it is the king of the currency world, but gold's the king of all of them.
Do you not see inflationary pressure on the horizon, though?
Not pressure. We hope there's a little more inflation, in fact. But so far, I think it wants to be a problem, but it hasn't even become being normalized completely. So we like to see it normalized first before we worry that it's a problem.
Sure.
But actually, it would be good for gold if there was some inflation, because it would make the interest rates more negative, right? So
True.
For gold's sake, good.
But you say that, but wouldn't what we've seen really over the last decade since the Fed has taken such extraordinary moves with quantitative easing and zero interest rate policies, that the markets tend to feed off whatever the Fed does or what they think the Fed is going to do. So contrarily, if we've seen signs of higher inflation, then gold's traded downward because speculators feel, well, in that case, the Fed's going to start clamping down or trying to raise interest rates if it sees signs of higher inflation. So it's been kind of a bizarro world in that sense.
Yes, it really has. It's almost like one of those telenovela kind of things where everybody just gloms onto every word or every action that the Fed does. But if you stand back and look at it, the Fed's basically just doing everything the president wants them to do, and we don't see that changing. And and it's not only the president. Everybody wants low interest rates.
Right.
The investors, the public, the homeowners, even Bernie Sanders wants low interest rates. So everybody wants low interest rates, and the Fed feels obviously that pressure, and they've caved in. It's very obvious. I mean, you can't prove it, but by their actions speak much louder than their words, and rates are going back down to near 5,000-year lows. I mean, so you can't, and it looks like they're going to stay low. And if you look at the other countries, there's almost all of them, except for the United States, already have negative interest rates. If you go 6 months out to about 6 years, negative interest rates are growing in popularity, maybe not because they want them to be that way, but they're forced to have negative rates. So the whole global trend is for lower rates, and I think that's pretty much what we're in for quite a while.
And now with the Fed seemingly trying to please the president from December to today, they made an about face. The rest of the world are starting to fall into that line too, that the president is telling the central banks what to do. So if that's the case, and to save the debt system of the problem of the debt around the world, that could be exactly what's happening, and so that can get kicked down further. In the meantime, you may have some okay times for investing in that. So it's actually such a fascinating moment we're living in right now.
No, it really is at historical times. And what another interesting point is that Japan started this trend pretty much over 20 years ago, and they're still playing along, and everyone's following in their footsteps. So, and they have been for quite a while now. So we just got the reinforcement in recent months that this is going to continue. And so you have to just kind of put that as number one, and then what do the markets do about the situation? And what we see is everything's going to probably start going up.
Yeah, it's obvious that the Fed has the stock markets back. I mean, everybody recognizes that there's a put in place. Powell was supposed to be a bit different, and the way I put it is that there's a Powell put, just like there was a Bernanke put and a Yellen put on the stock market. The only difference being that Powell was perhaps a bit more reluctant to put it out there, but he's certainly come around, and I think all of these markets right now are trading with that in mind.
No, I think you're absolutely right. And it was, remember the different puts with the different Fed chairmen. But yes, it's happening again. And so it is very, very interesting, very fascinating times, we think.
It's once in a 5,000-year situation. So
that's true.
That's what probably we always say, what are people going to say years ahead of time and look back on this time period? And I don't think we'll be alive to see it, but they'll be telling everyone, why didn't they do other things at that moment in time? It's going to be an interesting piece of history.
Yeah, but what do you think when they're looking back at this time? Where are they going to be? Will we even have the same monetary regime? I mean, the way that every downturn gets cured, as it were, or really not even cured, just mitigated by floods of liquidity, of new currency being created. At some point, doesn't the very idea of these fiat currencies, of this paper money, not just the dollar, but the euro, the yen, pound, every other major currency that isn't backed by something? Because when you just create it out of thin air to cushion every even minor blow to the economy, don't these currencies at some point lose all credibility? And doesn't the debts that they lead to, don't those mean that we can never have any kind of a normal interest rate environment again? So where will we be?
I think you're absolutely right. And at some point, but, we always say, when is that going to be? These things can last a lot longer than you think, as we've already seen. Because remember, years ago, a lot of us were saying, the debt's going to blow up and it's all going to come, we're going to see, repercussions and that. But you keep kind of kicking the can down the road. Japan's done it for almost 25 years. And so this could go on, but you're absolutely right. At some point, it is all going to the currencies will lose their credibility. They'll have to start a whole new financial system, and how that evolves, how that turns out, none of us really know. We can speculate, but it's going to have to happen because these debts are just way, way beyond any way being paid back or being treated seriously. And so it's really kind of scary for the long haul, but it's going to happen. I don't know if we'll be around to see it, but it's going to happen. And again, sometimes these things can take 50 years or longer.
Yeah, the Japan example is handy because, as you said, they have been in this basically zero or even negative real interest rates for decades. And they just seem to be continuing on like a zombie economy.
No, exactly. Yeah. And, just by coincidence, my daughter just went and spent like a month in Japan, thought it was the best place in the whole world, had a wonderful time. And I go, how was the economy? She said, everybody's very happy. Everything's plugging along. I mean, of course, if you're a tourist, it's very different, but there was no signs of stress on, as far as you could see on the streets and that sort of thing. And like you say, it's been well over 20, I think it's almost 25 years of negative or zero interest rates. And they have the biggest debt in the world. You know that. And so who knows? I mean, these things can keep on going. But Brian is absolutely right. It's not going to last forever.
Yeah, and in the meantime, the Japanese yen has been the strongest of the weakest ones because it is considered a safe haven, even though it's kind of like a crooked safe haven, but it's still considered that in the currency markets, which is pretty interesting.
Yeah, I'd call that crazy, but you can't deny it's
true. Crazy, but it's
true. We certainly have seen a lot of doom and gloom pronouncements on the debt in the economy over the decades, haven't we?
Yeah, we have. Ever since we started way back in the 70s, people were at that time saying, the debt's going to blow up and the gloom and doom. But it hasn't happened. I mean, we had a big...
Reagan came around.
Yeah, we had a scare in 2007-08, but then they managed to turn it around and get things back on track. So it is very fascinating times we're living in, we think.
Well, the website for the Aden sisters is Aden, Aden Forecast.com. So if you want to follow their work, we'll also share other links related to this show at goldnewsletter.com/podcast. Were there any points that we failed to address there before we let you go?
No, I think we covered a lot of territory, but just that, one thing is just, I think, worth mentioning. In the short term, meaning in the weeks ahead, we could see more downward pressure on gold, on stocks, on bonds.
Just coming into the summer.
Just maybe in the next month or so. But those would actually be good buying opportunities, in our opinion, unless things radically change, which we don't think they will because of the interest rate picture and our own technical indicators. But then once that happens, and then they bottom out in the short term, that's when we think we're going to see these breakouts we're more or less anticipating.
And gold shares, for what it's worth, it looks like the downside is limited now. We could see a little more weakness this month of May, but by June, July, we probably the loans will probably be coming close to an end, if not already. But they're getting closer.
Excellent. Okay, well, thanks so much for your time, and Brian, I'm glad to have you back on the show. I look forward to seeing the Adens in New Orleans later this year. So, thanks again.
Yeah. Thank you very much.
Thank you very much.
see you in New Orleans in a few months.
Yeah.
Okay.
Look forward to it, Brian.